Hey, my name is Tom Carpenter, and I have the privilege of moderating this panel on the Washington outlook. My distinguished colleagues are all established, in the know, folks that are in the weeds of Washington policy in the day in and day out. And hopefully, over the next hour and 10 minutes or so, we know we stand between lunch, so we'll try to stay brief where we can. But we want to really give you the inside scoop on how is the Washington scene and the Washington environment impacting the programs and the policy that you care about the most. And so we're going to jump right in. I want to introduce folks, and then they can add color commentary on themselves during questions. But Julia Gordon with the National Community Stabilization Trust, Lisa Mensah with the Opportunity Finance Network, Jennifer Schwartz with NCSHA, and Kris Siglin with the Housing Partnership Network. And we thought we would start kind of from a broad standpoint. And so I would love for you all to think about just kind of the overall environment. I think Congressman Meeks started out today, and he kind of made a joke about there's still a few things we do bipartisan in this town. There's a few opportunities out there. But I think, obviously, both for folks inside the Beltway and then plenty of folks outside the Beltway, the environment in general seems extremely toxic. It seems like almost nothing is moving of substance. And so I wonder if you could just kind of give a sense of the overall environment in and around housing policy and how you see, where do we see the opportunities? And then where do we see that toxic environment really kind of poisoning the well on some items? So we can go down the line if we want, or anybody can jump in.
No, I mean, I'm a former House staffer and Senate staffer, and it is shocking to see the degree to which people are not even speaking to each other. And Congress was designed to be a mechanism. You can't resolve anything if you can't talk to people. So, I would not be holding my breath about a lot of things happening in the short term, but I think it's also true that we may see a lot of change that we haven't even foreseen over the next couple elections. So people should be thinking about what works well in our current system, what could be better, and I think people should be using this time to get ready with ideas and approaches.
So I'm going to be a little bit more of an optimist. I agree that the atmosphere generally is toxic, but I do think that with affordable housing, there are some opportunities to at least make some incremental changes. And I think that there is an interest on both sides of the aisle of addressing aspects of the affordable housing crisis, or at least moving forward a little bit. And so, I mean, I'm very excited because, and we'll talk about this later, we had big low-income housing tax credit legislation that dropped, so that's bipartisan, dropped yesterday. But I mean, we have a short window before next year with the presidential election year, and obviously it starts eating into this year, more and more. But I still think there's room to do some things.
Great, and Tom, I might stay on that slightly optimistic note because that's what will be controversial at this time in Washington. I think there's always sort of, if I had to sum up my American government class in 3 words, I would say there's always legislative things, regulatory things, and appropriations, the money. And I think they're never, ever dead, those 3 conversations. Ledge is certainly tough in a time where we don't have a lot of bipartisanship. But the optimistic note is that there's been a rich time of hearings. It's actually been kind of fun for all of us in the advocacy and think business because this has been a busy time of people wanting our ideas and wanting to talk about this. And I would say that's on even bipartisanship. We had a powerful hearing this spring on the CDFI fund, which was very bipartisan. And regulatory, you heard a little bit on CRA. And while that's contentious, the fact that it's a play means it's a busy time. And finally, Appropes. This has been Congress's time to keep moving forward. And when we did get money, at least in our case for the CDFI field, this has actually been a strong time. So I'm looking forward to the longer part of our conversation. But I think those three debates continue to dominate. Washington always will, and it's not all bad news.
So I'll speak to something besides the governmental structures, which I think you all have covered, which is in terms of the external stakeholders, I have never seen a time of more collaboration among external stakeholders. I come from a background where the dynamic was often less a Democratic-Republican one than a sort of consumer bank or consumer industry dynamic, and I see an enormous amount of collaboration, strategizing together, and so, while we still have the challenges that we face in terms of the actual political process, my experience has been when you see broad coalitions of external stakeholders, you can often find a way to get things done.
That's a great point. So I want to revisit a couple of those points here in just a minute, but I think it's also interesting. So I've had the privilege of working with NAAHL for the last 15 years in this world, and seeing just over the last 12 to 24 months a semantic shift. Washington loves to be able to basically describe the same thing in a different way, and all of a sudden it's new for everybody. And I think it's been interesting to see the semantic shift from not necessarily from the practitioners and the folks in this room that do the work every day, but from folks in the policymakers, the regulators, going from affordable housing to housing affordability. And all of a sudden, it's kind of an in vogue term. And I think there is some perception around that, depending on which audience you're looking at, about, is affordable housing kind of one thing and housing affordability another issue. And I think it's been interesting to see kind of the bipartisan pitch of this. So Cory Booker came out this morning with a proposal on housing affordability. The American Enterprise Institute, a definitely kind of right-leaning think tank, has been putting a lot of energy into looking at housing affordability. Just did a study where they tracked that the lowest price tier of homes, those kind of starter homes, are the ones that have appreciated the most in the last 8 to 9 years. And so there's this push. And so I guess my question is, are these all green shoots for affordable housing in this work? Is everybody all of a sudden on the bandwagon? Or has this kind of muddied the waters a bit in a way where, no, the same is true generally in terms of those that are our allies and those we have to convince? But I wonder if you could just speak to, do you notice that difference as this has become a broader issue?
Well, I will definitely speak to that. It is quite clear, and much of my work is in the homeownership and single-family residential space. It is absolutely true that in rooms I've been in for a very long time, the term affordable housing is generally translated to mean rental housing, and it's generally further translated to mean subsidized rental housing or even just public housing. And that has made it difficult in some rooms to get to the conversation that's really about multiple forms of housing and multiple forms of tenure and ownership. And how do you have the conversation about actual affordability, like how do people's incomes match up with their expenditures on their shelter costs? And so I do think breaking out of the semantic box is necessary from a political perspective, because otherwise that shorthand affordable often just turns people's brains off and they can't have the conversation. That said, changes in terminology aren't going to mask like the actual thingness of what we're doing. Mm-hmm. So I think we still have to, I don't think it fundamentally changes the conversation, But I think you notice that shift in terminology because it's the only way to break out of certain boxes. This is also true, by the way, about home ownership, which became very difficult to talk about after the foreclosure crisis. And for many politicians, I was told it was completely toxic to talk about. During the 2016 election, I was told by several campaigns that they were told by their consultants to never utter the word home ownership. And I'm not, that also seems to be maybe shifting a little bit, but I still think we have some residue of that going on.
Great. Others?
Well, I would say that I think the problem of housing affordability, if we want to call it that, has gotten pretty broad. And so clearly it's still the biggest problem for the lowest income households. And a lot of the work that we do on the low income housing tax credit obviously has great benefit for the lowest income households. And I think that that's really, really important. But because it has become such a universal problem that is touching people in various aspects of the income spectrum, it's kind of like, we might get some good out of this, but we're getting good out of this for a bad reason. That affordable housing or housing affordability is unattainable for so many people. But I hope that we can harness that to, bring real attention and real solutions to the problems that we see. I do think that we have gotten attention from some of the people that you wouldn't think necessarily would support affordable housing. Last year, the bill, the big housing credit bill, had everyone from Mark Meadows to Keith Ellison on the bill. And when you have, the chairman of the Freedom Caucus who, signs on to a bill about affordable housing, that says something about the constituents that this problem is touching.
Have any of you noticed that your relatives are suddenly more interested in what you do? Yeah, I think that's a great leading indicator that housing and community development issues are gaining more traction. And it's interesting because my family is originally from the Midwest, so there are lots of dimensions to the housing problem. The affordability issues are obviously getting attention and drawing bipartisan support for solutions for these very expensive markets like DC or California. But there's also, we're going to talk later about the problems of blight and disinvestment. And I just took a blight tour of Davenport, Iowa, and there's an enormous community development needs in places like that as well. And again, traditionally, these have not been ideological issues. Our politics are really riven right now by these very angry ideological issues. But looking at distressed communities and thinking, what could we be doing differently, better? This question of housing cost burdens going all the way up the income scale, those things aren't necessarily going to be, aren't really ideological. So that's why I would encourage practitioners, and I've noticed the same collaboration Julia has. I think it's odd that maybe it's that when you see this very angry, dysfunctional behavior in government, it kind of it's making people work together more, because it's like, wow, if we want Congress to do anything, we have to all come together and go to them. So I would encourage us to continue to do that.
Yeah, terrific. Obviously, there's been a change in Congress. We have a different looking Congress than we had the last Congress in terms of Democrats controlling the House, and certainly in the House Financial Services Committee. Lisa, you mentioned kind of some interesting hearings that have occurred. You mentioned the CDFI hearing. What else have you seen in terms of the changes that have happened and the interplay? Are these kind of, you've got the Senate Banking Committee chaired by Senator Crapo over here, and then you've got Chairwoman Maxine Waters over here. Are you seeing any collaboration, or is it just that we're getting more attention on some of these issues from the House?
Well, I'll go for the second.
Okay.
We're getting more attention, and we're hoping for collaboration later. My colleagues, I think, really nailed your last question on the sort of semantic shifts and the space that's created. But in addition to the talk, I do see some evidence of urgency to respond I think if we bring Lori Goodman back here for a future time, she'll show the data that around what actually happened after the recession and foreclosure crisis to the stock. So they've got the numbers to show that the country's suffering from what really was a scale back in production, and is suffering from where the market has first gone to heal, which is up at the top end, which is why CDFIs and others are so important in the creation of housing that is more affordable at lower ends of the market. What I would put one more thing on the table of what is, I would say, a nuance in the Washington conversations, and it's the reason I get a lot of invitations these days, is that the word rural is back again. And I see David here from HAC, and I do think one reaction to the election was more eagerness to talk about small cities, rural areas, areas that had not really been front and center, and frankly to see the connections between the needs in dense urban areas, older cities, and rural areas, both of which did suffer in the crisis and have had years of non-investment. And it's certainly a place that puts the spotlight on the community development financial institutions practice, which is always to go where markets have a tougher time going. So I would say there's more appetite since I was formerly at the Ag Department as rural. I'm getting a lot of calls lately saying, we heard about this rural thing.
Yeah.
So
let's follow that thread a little bit. I mean, all politics is local. Kris, you mentioned kind of hearing whether it's relatives or other policymakers that maybe haven't been as interested, all of a sudden interested because their constituents are talking about it. It's a real issue back home. I think you juxtapose that with work that I've been involved in this year where, some of these states, some of these congressional districts where we say, great, who do we have back there? And you either have a wealth of support on the ground or you have a complete desert. And I don't know if any of you could talk about kind of that from a political side and how we connect kind of the local to Washington in terms of the importance of making sure that we have activities that are happening in every congressional district in a way that you can connect that policymaker back to a real issue. It's not just a Washington organization or a Washington lobbyist saying it, it's real constituents on the ground. So I don't know if you could speak at all to kind of where you've seen the green shoots of that and the help of that and where you've seen a real lack for our audience to think about back home.
I mean, you guys have done a terrific job with the action campaign.
The action campaign has been, I think, one of the real successes when we talk about the collaboration of different groups. For those of you who are not familiar with the action campaign, you should be. It is the large grassroots group that supports the low-income housing tax credit and is specifically lobbying for the legislation that we're working on right now. There are over 2,200 organizations across the country that are involved in this, and we're right now in the process of doing another big sign-on letter. So if you are not an Action member and would like to be one and would like to sign on to that letter, I would encourage you to go to rentalhousingaction.org and do that because it's open right now for just about a week, so that we're going to get that letter up to Congress. But letter writing is one thing and seeing a property is another. And every member that I have seen speak, and I've seen several in the last couple of days because there's been a flurry of conference activity, when asked, which they're always asked, what more can we do? How can we best message to support you in your leadership on these issues? They say, I became a believer when I went out and saw a property, and make this local, bring local members to speak to the members, bring the members to the properties. That is always the response that you get. And, we might think, oh, well, we've heard that all before, but it's because it's true. They don't, as much as I can come in and talk to them about the specific issues and the details that are in the bill, what sells them is when they go to a property and they see that this property is serving their constituents and it's beautiful and it's helping in so many other ways, and the impact that it has on the residents, that's what moves the needle.
I had a recent experience, Tom, of being with a set of board members from Opportunity Finance Network. And we did a set of meetings both with regulators and on the Hill. And there is nothing like feeling the push from local, grounded constituents. And I think so many of us who do work in this field broadly of housing and community development, that's one of our strongest attributes, is that we are grounded. We can point to examples. We have real people who wake up in the communities that, that members represent and that regulators can understand. It is a much louder, more effective strategy, which is why Washington, I think, will be a while before we completely convert to emails and phones and we'll be an in-person town. We had members say, you had me at hello. You brought my home person here to paint that picture. And I think that's true about these big issues. We have the stats, but having an advocate who does work grounded and local, that's one of the very persuasive parts of our field, and I think still in force.
So I'm going to say something not quite as positive, although I agree with all the positive things that have been said, which is on the sort of grassroots, neighborhood level community development activity, I think we've seen a real starvation funding-wise of a lot of the smaller neighborhood organizations. And for some of the neighborhood by neighborhood activities that need to happen in community development and that need to happen in areas that are not seeing gentrification by anyone's definition, or where you have a housing stock that is largely single family rather than multifamily, where you have vacancy, where you have blight. A lot of the previously available funding for that is shrinking or gone entirely. And so, I know from NCST's perspective, we really believe there needs to be some kind of successor program to the neighborhood stabilization program, because you just you can't do a lot of this work without some kind of subsidy in there. And I know we're going to talk more about our tax credit idea, but our organization, one of the main things that we do is we provide opportunities for local CDCs and other nonprofit mission-based housing organizations to actually get a hold of REO inventory before it's offered to the public or before all the sort of investors come and swoop it up to just use for rental housing. And there are so many jurisdictions where we just really no longer have that infrastructure to take advantage of this opportunity, and we need to see ways to rebuild that from the ground up. We see a lot of strong, high-performing nonprofits, particularly in the LIHTC space and doing that kind of work. But these smaller organizations are really starving.
Yeah, it's helpful to think about. So let's talk into some issues. I think it's important as we think about Washington Update, and certainly for the audience, as you think about, is this just a conference where I come and hear from the professionals? It really is this connection back home. And so everyone has a role to play when it comes to policy formation and then the nuts and bolts of moving it. But let's talk about where some of those things are today in Washington. And Kris, I'm going to start with you down at the end to talk a little bit about where are HUD appropriations right now. Sure. And then I would love if you would talk a little bit about the Neighborhood Homes Investment Act and maybe give a little describer to where that is and what it is.
So, as Lisa points out, something Congress has to do every year is pass appropriations bills. And in recent years, this process has been attendant with a great deal of drama. That when the Republicans took over the Congress in 2010, they and the Obama administration hammered out a budget agreement that would reduce federal spending over 10 years. And it was supposed to be so distasteful that it would never happen. So there are these budget caps that hit both defense spending and non-defense discretionary spending, and it has ratcheted down every year. And so such that over the past 4 years, the caps have been waived, and so Congress has been able to put together spending bills that didn't have really dramatic budget cuts. But this year, those budget agreements are no longer in effect. So something called sequestration happens. And what that is just automatic across the board budget cuts. So if Congress cannot get the appropriations bills done this year, $71 billion will be cut out of the defense budget, and $55 billion will be cut out of non-defense discretionary spending. So there's a real pressure for them to negotiate and reach an agreement on funding levels that are acceptable to both sides. So Senator Shelby and Senator Leahy are actually flying to Senator Cochran's funeral in Mississippi, and they were going to talk about the budget. And last year they were eventually successful in getting budget bills done by drinking bourbon together in Senator Shelby's office, which is much more how the Senate used to work. So meanwhile, the House is with a newly empowered Democratic majority on the House side, they're going ahead and pretending that the budget caps don't exist. And so they've begun passing spending bills that have higher spending levels for priorities for many people in this room. So the HUD bill has already moved through the Appropriations Committee, and they added $500 million to the, $500 million to the home program. It's $1.75 billion, which is a funding level we haven't seen in years for home. CDBG is up to $3.3 billion. They were able to fully fund rental assistance. So you can see that Chairman Price was expressing different priorities than you've seen. Meanwhile, the Senate is waiting for some kind of budget cap deal before they begin passing bills. But the initial, you can see the change, the electoral change in the new priorities that have been articulated in the spending bills that have begun to move on the House side. However, they're going to ultimately have to, the process was designed by the founding fathers that the president's going to have to sign these budget bills. So at some point, they're going to have to negotiate. And the process with negotiations has been inelegant. And
a beautiful word there.
and so it's hard to know what's going to happen. And to complicate matters, there's also something called the debt ceiling, which is the amount of debt we issue to foreigners who buy our Treasury securities, the interest of which our children are going to have to pay back. Not that I have an opinion on this, but the debt ceiling expires this fall. So we will default on our debt, which would then send the financial markets into a frenzy. So that's going to put additional pressure on Congress to get some sort of spending deal done. So stay tuned. That's going to be interesting. I'd also like to talk about something that is a kind of a constructive, collaborative, longer range project that a couple of us have been working with over the years, including Julia, Buzz from NAAHL, Tom Carpenter. Could you put up the first slide? There we go. So there's a long, the tools, as Julia pointed out, the tools that community developers use to deal with the foreclosure crisis have by and large expired. So things like the money's gone from the Neighborhood Stabilization Program or hardest hit funds. Yet there are lots of big American cities that have lost large amounts of population. And it's pretty startling to look at the numbers. I mean, you've got Buffalo, Cleveland, Detroit, Gary, Pittsburgh, and St. Louis all have lost 50% of their population since their peak. And as I heard the housing director of the city of Baltimore point out last week, when 350,000 people leave Baltimore, they don't take their houses with them. So there is a residual problem of areas that have suffered from economic disinvestment, job loss, jobs like steel jobs, car manufacturing jobs have gone away in the industrial heartland. And it's really startling to look at what the numbers are. So this needs some kind of community development response. And so there is a proposal called the Neighborhood Homes Investment Act. If you could do the next slide, please. That, one of the things that happens in these cities that have lost a lot of population, of course, is that property values fall. And then that becomes a downward spiral of it costs more to fix up a house and make it decent, safe, and sanitary than you can sell it for. So that discourages private mortgage lending. And then and as the stock then becomes older, most cities have 50-year-old houses. With the lack of investment, then new home buyers who might want to remain in the community, there isn't a stock of move-in ready homes, and so then the blight and disinvestment get worse. So, but you don't need to, but people can pay, there's people who still live there who want to remain in the community and can afford a mortgage, but you just have to cover that appraisal gap. So it's, the driver of the blight and disinvestment is the gap between what it costs to fix up the house and what you can sell the house for. So you can also, there's been a lot of work done that we've seen lots of examples that you can stabilize markets if you can fill that gap. And so there's different ways you could do it. You could do it with subsidy dollars, as was done with the NSP program, but you could also use the tax code. So a group of us are working on the Neighborhood Homes Investment Act, which is basically a tax credit that fills the appraisal gap. And the way it would work is it's modeled with much of the success of the low-income housing tax credit program has been due to its state administration. So this would give states a choice to either use unused private activity bond funding or use their a capped and allocated credit, because some states are out of their bond funding. And the states would develop plans to allocate these tax credits to developers who would work in distressed communities. And this would be an example of for a rehab example. And investors would only get a tax credit for the amount that was necessary to fill the gap, and then the homeowner would pay the mortgage. If I could have the next example. So it could be for new construction or rehab, because again, these cities haven't seen investment in years. Somebody was telling me about Battle Creek, Michigan, has not had a new home built since, I think they said 2004. Wow. So, and it's important that this, with all the concern about gentrification, as we were talking about earlier. The next slide, please. One of the things that's really important with a program like this is that it be carefully targeted to distressed communities where the tax credits will do some good, and not, what you don't want to do is pour gas on gentrification of you don't want to give people tax credits to go into a neighborhood that's already improving a great deal, and then that will just bid up prices. So this is based on the lessons from the New Markets credit, it's geographically targeted to neighborhoods where there's a higher poverty rate, house prices below the median, and incomes below the median. So it's trying to get the resources where they're used most. And so about 22% of census tracts nationwide would qualify for this. So we've had exciting news this past week. We're pretty close to getting a co-sponsor, Republican and Democrats, to co-sponsor it on House Ways and Means, and we've got a good Democrat on Senate Finance, and we're still working on the Republicans on the Senate side. But what we're hoping is to have this along the lines of having constructive proposals ready to go. Tax bills always get put together with all sorts of things added in at the last minute. Our theory of change on this is to have something ready to go so that if a tax bill moves, we've got something that, and this is a non-ideological, bipartisan way to fix what's a market failure. So we're excited to be moving ahead.
Thanks for that description. And what's interesting is I was just that's Erie, PA, there at the very the top part of the screen next to the lake, and I was in Erie just last week with Republican Congressman Kelly on this. We did a neighborhood tour, just like we were talking about earlier. And it's amazing to see what otherwise would be kind of a glaze over, how long does it take to get through this meeting in Washington conversation. But we walked 2 square blocks with Congressman Kelly. We're pointing out houses where folks live, but he can see the blight.
Right.
And he can see, now this house would only sell for $35,000, but the cost to actually bring it up to code and fix it up is probably another 50 to 75 or above. And so he immediately gets that, a quick kind of neighborhood walkthrough. So thank you very much, that connection on this. So let's move on to a few other things. Jennifer, you were just talking about a big day yesterday. Wonder if you can give everybody an update on where LIHTC is and what the prospects are for the bill.
Well, we're very excited. So yesterday we had the Affordable Housing Credit Improvement Act dropped in both the House and the Senate, which is great. Many of you may be familiar with this bill because we did have the legislation in the last Congress. It had fantastic support in the last Congress, and we actually got some movement on it because we were able to get one of the provisions from last year enacted. That was the average income test, and also what we consider a down payment on the cap increase that we're seeking. It was a 12.5% increase in housing credit authority for states for 4 years. So that was really exciting to have some real momentum on affordable housing initiatives last year. But this year we're back and we are better than ever. So the bills are in the Senate. It is S7. Oh my gosh, I can't believe this number went
You're
out of my
forgiven
head.
for that. Just introduced
1703.
yesterday. All right, there you go.
And it's introduced by Senator Cantwell and Wyden on the Democratic side, and our two Republicans are Senators Isaacson and Senator Young. We have a 4-champion strategy in both chambers this year, which is really exciting because all 4 of them are very, very jazzed up to be working on this and are going to be taking responsibility for the bill and for moving it forward. On the House side, we are HR 3077, and our champions there are Representatives Delbene and Marchant, and Beyer and Walorski. So again, 2 Republicans, 2 Democrats. We're very excited about this. So just to give a little bit of information about what is in this bill, it is very comprehensive legislation that deals kind of soup to nuts with the housing credit program. And so that is everything from some big proposals that would actually increase production. So we've got a 50% phased-in cap increase, which this year is in both the House and the Senate bill. Last year was only in the Senate version of the legislation, so that's a huge change. It also takes that 12.5% increase that we got in 2018 and makes that permanent, and then as part of the baseline, and then builds the 50% increase on top of that. And so that's great. It also has the minimum 4% rate for the bond finance deals, something that I know is really important to make some of those deals work better, allow more equity to be going into bond financed housing credit properties, which will allow a number of states that aren't using all of their private activity bond cap to make much more efficient use of that bond cap because you've got more credit equity going into it. There's a provision in there that I'm really excited about that I think is kind of a sleeper provision that not everybody has paid as much attention to, and that is expanded bond recycling. So for those states that have been using all of their bond cap for quite some time, New York and Washington and Minnesota and Massachusetts, basically what this is going to allow them to do is to use recycled proceeds from multifamily bonds to fund their mortgage revenue bond program. And by doing that, they're going to free up the new cap that they currently use for MRBs to be available for multifamily. And that means that more 4% credit deals are going to be able to happen in those states, and that's a huge increase in production. So we've got the various things that increase production. There's also a number of other provisions in there that help make the credit a better tool for preservation of affordable housing, make it a better tool for reaching some of the really hard to reach populations. So there's a new rural basis boost provision that is, again, new to the bill this year. A number of other things that allow us to better reach rural areas, Native American communities, and extremely low income households. So very excited about that. And then just lots of other things that clean it up, make it easier, things that maybe not everybody is cued in on, but the compliance folks at my agencies are really excited about. So we couldn't be more thrilled to have this bill out there. I really do believe that, as far as our opportunities for advancing affordable housing legislation go in this Congress, this is really where it's at. And not to take away from any of the many other things that are, addressing other problems that are outside of the rental sphere, but, those are all really critical as well. But when it comes to affordable rental housing and how do we, really combat the problem that we're seeing, this is a place where I think we have really great opportunities for bipartisan support. And we hope that we will be able to quickly get as many co-sponsors as possible on the bill, although I will say that our sponsors want to keep this relatively even from a party perspective. It doesn't mean it'll stay completely even throughout the whole run of the Congress, but we are hoping to do a Noah's Ark approach where as a new Republican comes on, a new Democrat comes on, and it doesn't get weighted one way or the other. So that's where we are with it. I'm happy to answer questions about individual provisions as we go forward, but I think it's great. And please, if you're up on the Hill this week, ask members to co-sponsor this legislation. And yeah, it's great.
Yeah, thank you. Very exciting. All right, Lisa, talk to us a little bit about CDFI appropriations. I know Kris talked about appropriations, so give your spin on it as well.
Kris did a brilliant job, and I think that should be repeated and taught in classes. That is the last 10 years of approps policy in a few sentences. So we watch very tightly, we the Community Development Financial Institutions field, the appropriations for the CDFI fund. And I see Ellen Lazar, who was there at the beginning of that fund. It's almost 25 years old, started in the Clinton administration. And while the skinny budgets proposed from the administration zeroed out this fund, in every year the fund has actually been sustained. So we've and grown some. So we reached $250 million of appropriations for something called the Financial Assistance Awards. And we saw yesterday, this is a good day to have this panel, the House approved $300 million for the CDFI fund for the 2020 appropriation. I will say a couple of things. As Kris pointed out, that's the House. So we are hoping that there's plenty of bourbon and that Senator Cochran's angel does some good work for us. But there's more to go. But this has been an important time for us as a field. Julia mentioned something that I want to double down on, and that is the critical role of funding the local infrastructure. So this appropriation, it does two things. It's the real jet fuel for the local infrastructure of CDFIs. Getting these kind of awards from the Treasury allows these institutions to leverage, we say 12 to 1. There are institutions who can prove 50 to 1, meaning $1 million FA award, and many have been much less than that, $500,000. You really are then able to borrow capital from banks, from others, and lend those dollars into the community. So for particularly loan funds who can't issue stock or have other easy ways of getting equity, that's really critical. But it's important for our credit unions, important for our CDFI banks, really critical piece of legislation for us, and we watch it very tightly. I should also mention not all of the Treasury's funds take appropriations. So for instance, the CDFI bond guarantee program is in Washington parlance a zero subsidy program. And that's something we are very much watching and support. It's been a $500 million authority, and that is a critical source of long-term 30-year bonding authority. And OFN is an issuer to about 17 different CDFIs who borrow under that program. So not all of the things that we watch are pure appropriations. In this case, we have a bond guarantee effort, but those are something that we watch. It's one of the highest priorities of our field, and it's because of what Julia said. This supports the institutions who do the lending.
Great, thank you so much. Julia, let's talk a little bit GSE reform. We just heard the congressman this morning give a rousing support for its prospects in Congress, but clearly a lot of buzz about what the administration might do through FHFA, and wonder if you could give us your take.
Well, I have to say, first of all, let's all just have a heavy sigh for GSE reform. And also, I spent the last week kind of stressing. I was like, oh, please, God, don't let the administration release that thing the day before I'm on this panel. So that did not, in fact, happen. So I will apologize in advance if I get a little judgy when I talk about this topic, because I think we may be about to see the consequences of a lot of people feeling that kicking the can down the road was a good idea. So, you know, Fannie and Freddie have been in conservatorship now for 11 years, and that has enabled sort of business as usual in a lot of ways. And, you know, through the PSPAs, they essentially have the government standing behind them and guaranteeing them, essentially. So over the years, as most of you know, there have been multiple proposals, both, you know, actual bills that have received hearings and votes in Congress, as well as multiple plans offered by multiple trade associations and, you know, groups of thought leaders. The different variations, you know, span the full spectrum. We have plans for multi-guarantor systems with Fannie and Freddie wound down. We have plans to use Ginnie Mae as the backbone of the system. We have proposals for a regulated utility. We have proposals for a single government corporation. Pretty much everything that you can have out there. We have proposals to keep things essentially the way they are, but with some kind of full faith and credit guarantee behind Fannie and Freddie. And so with all of those proposals and all of the talk and all of the whining, what we have now is we have a new director of FHFA who has given, I don't know, like 400 speeches in the last 2 weeks, it feels like, that are making it very clear that where we are going and where we might be going very quickly is just right back to where we were. Right back to a system with privatized gains and socialized losses, right back to a system that is pro-cyclical as opposed to providing some kind of, you know, counter-cyclical force. And just weirdly, I don't hear like a whole lot of, everybody should be running around kind of screaming about this, because this is the backbone of American homeownership. Now, for those of us who work more with LMI communities, frankly, the GSEs have been a tiny bit irrelevant for quite some time. That lending is happening through FHA. That lending will continue happening through FHA until there's some kind of plan to do something about FHA. But a lot of the progress that has been made under the GSE conservatorship, like the credit risk transfers, and, you know, a number of the kind of imaginary capital requirements in place there. Those are all great developments. We've learned a lot from them, but they are all developments that would become somewhat irrelevant if we had another big downturn. So I don't want to, I actually disagree with Congressman Meeks that doing nothing right now is the thing that will do the least harm. I think there is possibility that harm will be done here. There are global investors who will not be able to buy agency bonds if there is no kind of government guarantee standing behind them. You know, there are other consequences for what the TBA market will look like and what the prospects are if we have another downturn. So you know, it is probably time for Congress to get serious about this again and to not let us end up in sort of this weird denouement exactly where we started. We also have a number of other things going on in addition to just GSE reform the way we've defined it over the past decade. One of the things Director Calabria has expressed interest in is obtaining authority for FHFA to charter new GSEs on its own. Now, something that nobody's really spent a whole lot of time talking about is, it's kind of like in The Wizard of Oz, you had the power to go home all along, just click your heels 3 times. Congress has always been able to charter new GSEs if they wanted to. That hasn't happened. But it is interesting that Director Calabria is looking toward that as a possible function of FHFA, which is just a whole new ballgame in a lot of ways. Another thing that is kind of coming to a head now, which is both inside baseball and very important, has to do with the Dodd-Frank rules around ability to pay, and a little subset of those rules called the qualified mortgage. This little subset of the rules in Dodd-Frank established what was supposed to be kind of a super safe category of loans. Like most statutes, Dodd-Frank left a lot of the definitioning up to a regulator, an agency, in this case the CFPB, which made some interpretations of that statute that established a safe harbor for loans made that had certain characteristics. Most of these were product-related characteristics as opposed to like underwriting requirements, but through the process of things regulators do, one of the things that was established was a debt-to-income ratio cap of 43% for loans to get into this super safe category where kind of nobody can sue you ever. And that was all great, except there was one exception, which is Fannie and Freddie. Okay, so if you were going through Fannie and Freddie, you had this exception to this 43% DTI, which gave Fannie and Freddie an enormous amount of ability to continue to lend. This is particularly important for underserved communities, for lower income borrowers, where the ability that Fannie and Freddie have had to use other compensating factors in order to go beyond that hard cutoff of 43% has been really important for lending. At the same time, the 43% applying to everybody else outside Fannie and Freddie has been certainly one of the factors that has kept us from seeing a lot of growth in the purely private lending area. So when the CFPB gave Fannie and Freddie this loophole that people call the patch, they said, well, we're going to set this date that seems really, really far away, where we'll have to have worked things out with Fannie and Freddie by then and worked all this stuff out, because then that patch is going to expire. Fast forward, okay.
A long time.
People have had kids, the kids have grown up, they've been bar mitzvah, whatever. And we are coming up to the time where that thing is about to happen. And even, there's been much talk with Director Calabria coming in, how is he going to cut back the footprint of FHFA? Ironically, the thing that could happen to cut back the footprint the most in a very blunt instrument kind of way won't even have to do with the FHFA at all. It will have to do with the CFPB. And so that's another issue that's kind of mushed in with all these GSE reform issues that we have to be paying attention to right now.
Very helpful. So I want to leave some time for questions here at the end, but I have a couple other questions kind of for the group. Maybe we'll take off of that GSE reform thread just to think broadly about, GSE reform is one where the Congress can never seem to get its engine moving. And I think largely it's a fear and a political will standpoint. Does anybody really want to touch the third rail and be said to be responsible for screwing up the 30-year fixed? especially in the last decade plus where people have enjoyed historically low rates. And so there's this kind of baked in notion that if mortgages ever cost more than 4.5%, well, it's probably whoever's fault messed it up. So I wonder if you could talk a little bit about how you see this playing out kind of across the board in your experience, where either it's the fear of messing up or just the polarization and the lack of bipartisanship and how that's impacted. And then I'll ask you also to add maybe one other thing. What is an optimistic note? What's a green shoot, maybe even from the administration or from the Congress that folks may not be aware of that you've seen or noticed in the last 6 to 12 months?
Well, eventually Congress does act when faced with a crisis. So sometimes, and in the case of the GSEs, we're waiting for a plan from the Trump administration that's going to be out later this summer. And these issues have been very thoroughly chewed over. And as Julia points out, the expiration of the qualified mortgage patch might spur some congressional attention to housing, which is 20% of GDP.
Yeah.
So I would say that when we talk about GSE reform and no one wants to touch it and all, will this ever happen? We went through something similar with tax reform for many years of lots of talk about tax reform, but no one acting and having a number of third rails involved with that. And then suddenly it was done in like a month and a half. So,
That's right.
Who knows? As far as my optimistic shoot, I would say that every office that I go into wants, and maybe you could see this as by both optimistic or maybe pessimistic, I don't know, but everybody wants to have their name on an affordable housing initiative of some sort. There's a lot of interest in ownership, and that's because it is rising in the news, and more and more members feel like they want to be seen as a leader there.
That's great.
There's absolutely no way to build on what's been said. Julia should be on every TV show explaining what the heck is going on in housing finance reform. So I'll take a green shoot comment, and maybe I'll think about a couple here. In the midst of the crisis, the Capital Magnet Fund idea was piloted, and that's been an important source of capital for CDFIs, and we were relieved that the funding was released under that program last year as was designed. And, maybe a little green shoot is that sometimes pilots inspire and hang around and are able to be made permanent, and we're going to hope that and we'll be in an advocacy mode for that. The other kind of big green shoot that I have relates to the things we've been saying up here, that whether it's crisis or ego or market pressure or this great cloud of collaboration that's happening on the outside, that I take as a green shoot that it's not 2008, it's 2019, and that it is a time to deal with one of the core human needs of shelter, and that we do find ways to talk about this that are bipartisan, and that we have partners, perhaps not equipped enough, but a field that has reached a certain place of sophistication that would be ready to receive more funds, more subsidy in order to solve the problems. I think if we look back at our field of community development, there was a big chunk of our experience over the past 50 years where we were proving that there were organizations, particularly on the nonprofit side, who could do this, who could lend money, who could lend it efficiently. And that we're beyond. So I think we've made that proof point. So my green shoot is that if there were ever a time to come back to the table and move some of these things. It's, you know, it's after a crisis when things are ready to rebuild, and that we're here, we the larger field of community development financial players. So that's my big green shoot, my little shoot.
So I'll say more things since I can. I think a productive way for us all to go, both members of Congress and those of us in this conversation, is to think about GSC reform as if it were actually housing policy, because it is. Let us develop the vision of what we want housing and housing policy to look like for people living in this country. The plumbing and the capital flows should be in service of that goal. But we tend to start the conversation from the perspective of the capital markets, and we're like, okay, we have plumbing that looks like this, and maybe that didn't work in certain ways, so are there ways to reattach this pipe to this pipe or whatever? But we're not looking at what's flowing out the end of the pipe. We haven't really had a serious national conversation for a while about some of these fundamental questions. I mean, such as tenure. Have we lost faith in home ownership? I mean, I haven't, just to be clear. But is that, you know, that is certainly a conversation we need to be having. What does it mean for this country where so much of the strife that we're experiencing has to do with race? What does it mean when you have 70-some% of white families owning a house and only 40-some% of black families owning a house? That says a tremendous amount. Residential segregation, we've barely made a dent in that. You know, those things mean something for everything else, for education, for health, for jobs, for the future of our kids, for everybody's individual and personal safety. And like housing is so much a part of this. What do we want from housing? And then let's build a system that directs capital in a way that supports that vision that we have. I know that sounds a little utopian, but I feel like it just needs to be said every once in a while.
Thanks for saying it.
Bravo.
So we should totally end on that optimistic note, but you can't do a Washington update without getting into the juicy politics of the upcoming presidential election. So quick, in 30 seconds or less, who is the Democratic nominee and why? And do they beat President Trump or not?
Oh, that's not fair.
No,
You
you're
didn't
on the
tell us
record
this
here.
one was coming.
Yeah.
You know, I generally at HPN stick to the policy of I make no predictions because I woke up and Donald Trump was president. I'm out.
All right. All right. Who has some guts?
All right, look, I got no guts, but I'll tell you, when it comes to housing, I will tell you the candidate who understands this stuff is Elizabeth Warren. I'm not saying she'll be the nominee or whether or not she can be. Look, beating Trump, which, you know, is kind of an imperative at this point, it's hard to predict, and it's, you know, in my view, it's about base turnout, and I do not think it's productive to talk about who can beat Trump. I do think it's productive to talk about, you know, who seems to have policies that make sense. I haven't endorsed anybody. I can't, certainly not speaking for NCST or anybody, but I have, I know which people are candidates for president who I have worked on housing issues with over the years. And certainly when it comes to GSE reform, Elizabeth Warren really put herself out there when we were having this serious conversation around the Johnson-Crapo bill sort of the last time around. But, really worked very well across the aisle on that. And I think in this room that deserves some recognition, and is grappling with some of these issues of the legacy of redlining and what to do on that front, and home ownership and rental and how that all works together. There are a few other candidates who have talked about housing. Cory Booker talks about housing, but not a whole lot of them. So that's all I'll say about that.
All right, so far we're living into our Washington stereotypes here.
Yeah, okay.
Absolutely gutless on any predictions, and won't take an official position. I want to wake up after the primary is over and just go to work. But I'll tell you what our CDFIs are doing. They are engaged at ensuring America votes. And there is greater energy in our network around making sure that people have the franchise. I've seen much more interest in the move around returning citizens. We are the financiers of many businesses led by returning citizens. So there's been much activism around getting that vote, that franchise expanded. And I've sort of seen a return to some of the more C parts of the community development financial institutions movement, which is engaging in the community and its desires. So
We are weenies.
I want to wake up in the final throes of this, and I think we will.
All right, I'll make a prediction.
All right, thank you,
It's going to be a boring one, though, okay?
Okay.
And I'll, could very well be wrong, but I think the Democratic Party is going to want to choose whomever they think has the best chance of beating Trump. I think that, Biden continues to soar in the polls, and I think that he will get the nomination. And I think he will have a very good chance of beating Trump. So I'm not going to say that it's definitely going to happen, but Trump has that narrow path, and I think that Biden can really go toe-to-toe in some of those areas.
Does Jennifer get like a prize?
She gets a
I want a
prize.
She gets a
prize.
prize. She should.
I want a prize.
She was
prize.
brave.
I'm probably completely wrong.
Well, no,
I'm not making an endorsement.
I'm
I'm
gonna
just
take,
throwing something out there.
Yeah, well, Tom, what do you think?
I'll take
Are
moderator
you gonna-
privilege
okay.
as well. Here, so I actually agree. I think Joe Biden is the nominee. My one caveat asterisk on that is that I believe that a large part of our electorate is an American Idol-ish electorate, and that the debates actually matter, and that they don't matter because of substance, but they matter because who's going to crash and burn with a bad answer, who's going to have a bad night, or who's going to have an amazing night, and all of a sudden, move quickly up the polls. And I think it's early enough. So that's my one caveat. And I do actually think, I think Joe Biden is the next president as well. I find it very difficult to believe that Trump's going to be able to put together what he did the last time. So that's my prediction.
It's amazing how much better I feel about my prediction having heard your prediction.
Well, and don't forget that the voter turnout in these last midterms was the highest it's been since 1914. I mean, that's...
Yep, says something.
Says something.
All right, so we have 6 minutes left. We'd love to take any questions for our distinguished panel of Washington experts. Here we go.
Jack.
So I just found it interesting that I'm going to say a word for the first time, I think, all day today, which is homeless. And I will say that because in most casual, I think conversations among casual observers of housing,
Yes.
the quickest rhetorical shortcut between the need for affordable housing, or to demonstrate the need for affordable housing, is homeless. And how many times have you heard people say, oh, look at the people sleeping here, or look at the homeless, we need affordable housing. And I have problems with that connection, that quick connection that's commonly out there. But I think that is most often the first connection I hear. And so far today, none of us who are the practitioners, that hasn't been the connection that anybody's made. And I just wonder what your comments are about, because in fact, you've talked about the need for housing affordability expanding a different way than that, and that's expanding the conversation. So I'd just hear your comments on that.
I'll say, while panelists are thinking, I think that's an excellent point. It's interesting that Chairwoman Waters, her first hearing as the chairwoman of the committee was on homelessness. And that is something that she has prioritized as a key issue. And so I think it is incumbent to think about that in this general conversation.
Well, and it certainly crystallizes the lack of affordable housing in expensive cities. I mean, when I talk to HPN members in Los Angeles, in Seattle, in San Francisco, and walking to my office in Washington, D.C., there's humans living on the sidewalk right next to Union Station. Human beings in tents who've been there for years. So when I raise this issue of systemic problems that we need to think harder about, it's a resource issue. It's it's resources, it's programs, it's connections between the silos. But that probably is the most vivid manifestation of the lack of affordable housing, particularly in expensive cities where poverty, the cities have done a good job of ending chronic homelessness. So a lot of long-term people with behavioral health issues and substance abuse have been housed, but the door to homelessness just remains open amongst low-income people who are unstably housed, who have exploitative landlords, and it just the statistics are alarming.
Well, and it's such a spectrum, right? I mean, homelessness doesn't just mean the person living in a tent outside of Union Station. It's the people who are inadequately housed. It's the people doubling up. It's the people who do shift work where somebody sleeps in a bed during the day and then a different person sleeps in that bed at night, or even more shifts. It's kids who are from one relative to another. It doesn't all look the same, but I think all of this is in service of trying to understand that having adequate, safe, sanitary shelter is a precondition of sort of all functioning in society. And that kind of, as you go up the income spectrum, it remains a precondition of things, right? In order to be properly educated and have good health, you really do need decent shelter. But going on up the spectrum, if we want to have a vibrant middle class, people need that stability and the affordability and the other things that enable you to go out and have a job and have your kids get educated. And we have all kinds of forces acting out there at all levels that threaten this in a lot of ways. I mean, I'm just in terms of middle class and as well as especially low and moderate income populations, but even up through the middle class, I'm concerned about the trend toward single family rental ownership as sort of the new darling of the investor class, because we're seeing more, the old system where when you're ready to move, you sell your house and you list it on the MLS and another family sees it and buys it. That model is just, it's sort of going the way of branch banking. And that has very serious implications we haven't talked about. Another thing we haven't talked about along the lines of not saying the word homeless is talking about senior housing cost burdens. I have been worried since the beginning of the foreclosure crisis about octogenarian tent cities. And we're still kind of moving that way and not really doing anything about it. And that's a confluence of the inadequacy of our healthcare system and our elder care system, along with this amazing housing cost burden that many of our seniors are still carrying. And that's, you know, as the boomer generation goes through that, that's just going to be a, am I allowed to use the term shit show?
You just did.
So yeah, there are just so many things, and we can't sort of get to them all. But to get back to the Washingtonness of this, our politicians need to be paying attention to these things, and we need to make them pay attention.
Thank you. So we are out of time, but please come and grab any of us if you have a burning question as you're maybe waiting in line for lunch. But please join me in thanking our panel.